So welcome everyone to the ClearVista Financial Monthly Market Update. It is March the 5th, and we have had a very interesting month and week here at ClearVista Financial, and actually in the economy and around the world, actually. So as always, we're keeping a close eye on what's happening in the markets and the economy. And so we'll walk through all this stuff. I present to you a lot of data. The federal government's got caught up a little bit from the government shutdown in the fall, and so we're now getting data in a normal time frame as usual. So today we're gonna talk a little bit about the market recap. So let's jump into the agenda, okay? And we're gonna talk about how the indexes did as usual in the month of February, and then we'll talk a little bit more about the current state of economy. We'll get into a little bit of the impacts of U.S. and Israel's war with Iran, and that obviously is impacting markets as well. But you can text your questions during the broadcast to 254-282-0495 or send us an email at info at clearvistafinancial.com, and we'll do our best to answer those during the program if we can. If not, we'll get with you within 24 hours after we finish our recording today. So let's jump right in with the market recap. The indexes were really flat or negative for the month. The S&P 500 was down almost 0.5%. The NASDAQ, tech-heavy NASDAQ, was down 3% in the month of February. That was mainly to concerns over whether AI is here to stay and if we've been overinflating that. The Russell 2000 was positive. Well, actually, the small caps were the strongest sector this past month. The Russell 2000 up 0.94%, almost 1%. Long-term treasuries, this is longer term than 20 years, we're up 1.82%. That's a positive thing for bonds. And then the moderate index we use to track a lot of different things is up 1.45%. And as always, I have to share this disclosure with you, and that the S&P 500, you actually can't invest in an index. Okay, so let's go along. There will be a quiz at the end of the day's program for this little disclosure. Let's talk about volatility. Now, normally going into the month of March, we generally, seasonally wise, we see an uptick in volatility. Now, this is just the volatility index for the S&P 500. You see it ebbs and flows all throughout the year, but generally in the month of March, we see a little bit higher volatility on average. Let's throw in an international conflict or a war. That's going to cause an addition to that volatility. So, we're headed up in volatility terms. Normally, from a seasonal standpoint, there are added factors there that are adding to the uncertainty and creating additional volatility, okay? So let's jump into the economic update. Remember, you can text us questions during the program today, 254-282-0495. Let's jump in the yield curve. Now, bond yields have risen in the last week since we attacked Iran on Saturday morning. We saw the 30-year Treasury up above 4%, or excuse me, the 10-year Treasury up above 4% on Monday. So we're going to see a lot of volatility there with yields as people maybe go to risk-free assets or less risky assets. We haven't seen that like we normally do with an international conflict like this, but bond yields have risen slightly this week. Since the end of the month. Let's look at the consumer price index back in January. So inflation came in below expectations with the headline inflation at 2.4%, the core inflation 2.5%, both near the lowest levels we've seen in several years. And this is despite concerns about tariffs reigniting inflation. We haven't seen that yet. The bigger driver of inflation, we think, is the money supply, and that's been relatively restrained. We haven't seen the growth in that we might have expected with that. And that's really why inflation has continued its gradual, albeit bumpy, decline. Energy prices helped this month. Of course, this was in January prior to the U.S. invasion of Iran or attack of Iran. I don't think we've actually invaded. We don't have people on the ground there. But housing costs still remain a big pressure point. But even that rent growth is beginning to cool as well. So you want to look at that, the producer price index. Also, make sure I didn't miss something here. Okay, good. The producer price index, producer prices rose a half a point in January, which was a little bit higher than expected. So it's kind of, you're seeing these conflicting views of the future. Producer prices, the prices that people pay to produce things, went up. Inflation was a little bit cooler than expected for the overall economy. However, with this situation here, even though it's one of the largest monthly increases since 2022, the thing we want to focus on is a trend, not a single month. And so on a year-over-year basis, producer inflation is running about 2.9%, just a little below 3, which is still a much lower moderation than prior peaks that we've seen before. Much of January's spike came from a sharp increase in wholesale margins and things of that nature. That's something we'll keep an eye on. As far as employment, non-farm payrolls, 130,000 new jobs. That was double the expectations. We only expected 70. Even better, private payrolls rose 172,000 while government employment declined. We also saw strength in some of these alternative measures like civilian employment. The labor force expanded as well, and unemployment ticked down to 4.3% in January. Wages rose for the month, but when you combine that with increased hours worked, total earnings had one of their strongest gains in over a year. So that's good news there on the employment front. All these signals are not really giving us a lot of indication of how the Fed might treat interest rates. There's a lot of conflicting information. Some that says, well, maybe we should cut interest rates. Some says, no, not so much. And the Fed meets later this month, the middle of March, and we'll report on that in our April update. All right, personal income and consumption. The consumer is really still propping up a lot of the economy. We finished the year in December with solid income and spending growth. Income was up 0.3%. Spending was up 0.4%. But with that said, the wage growth in the private sector slowed a bit in December. Now, some of the income boost came from transfer payments. That's just from government programs, not just organic wage growth. And in the long term, we want to see stronger private earnings driving the economy. And so as far as spending, consumers continue to favor services over goods. And that's been a pretty consistent trend for some while. What about housing? I know here in Central Texas, we're looking around, we see lots of for sale signs up and the houses are not moving. So December showed a slight dip in new home sales, but that followed the largest monthly gain since 2022. The broader trend here is what really matters, okay? Sales are up 3.8% over the past year and running at their fastest pace since 2022. Now, this is for new home sales. Activity is now above the pre-pandemic levels, which tells us the market has some more resilience than many expected. Now, for resales, we're seeing those resales, I think, slow down a little bit more, but this is for new home sales. One key support of this growth is lower mortgage rates. I think last week we saw the average 30-year rate on a 30-year mortgage tick below 6%. I don't know if that's changed since the U.S. attacked Iran, but we'll have to keep an eye on that. But that was good news for housing and stuff, okay? All right. We'll be also watching to make sure that, if the Federal Reserve cuts interest rates, that should trickle down through mortgage rates and affect the housing market. What about gross domestic product? This is our measure of economic growth. The headline number looked kind of soft. We kind of pulled back in the third quarter. We were at a rate of over 4%, but that retracted quite a bit to 1.4% growth. That was well below expectations. But in the details, there's a lot of stuff that's more encouraging. Fourth quarter growth came in around 3.2%, making really that's three strong quarters and roughly 2.7% for the year. Now, consumer spending, as we mentioned earlier, grew at a healthy rate, and that consumer spending tends to carry the economy quite a bit, especially in the services. So we'll keep an eye on that. The core inflation, that's consumption plus business investment plus housing, that was growing at about a 2.4% rate. If you look at the nominal GDP, this is basically taking inflation, but not factoring in, or taking GDP growth, but not factoring in inflation. That was growing at a rate of about 5.1%. So the economy is not looking extremely weak. There are some signs that we're kind of watching to make sure they don't deteriorate more, but the economy seems to be running quite well right now. Let's talk about industrial production. It kicked off the month of the first part of the year very strongly. January was the largest monthly gain in nearly a year. It beat all the expectations. Up over the past 12 months, production's up 2.2% overall, and that's reflected in a 2.5% increase in manufacturing. And that has been the fastest pace we've seen since the post-COVID reopening period in 2022. And manufacturing was the main driver in January, especially led by automobile production. Core manufacturing, when you strip out automobiles, was up 0.5%. And high-tech production continues to shine. That was up over 8.9% there. So let's talk a little bit more about manufacturing. This is the manufacturing index, the ISM index. The headline was at 52.4, marking back-to-back months in expansion territory. Anytime you see a reading above 50, that indicates expansion in that particular part of the economy. 12 of 18 industries reported expansion, and new orders remain strong as well. Production is expanding, and importantly, order backlogs have moved back into growth mode after being in contraction for over the last 3 years. So these are all good signs that the economy is slowly improving here. What about durable goods? When you look at it, durable good orders fell 1.4% in December, but that was better than a -2% contraction that economists were predicting. When we strip out transportation, even though I believe that transportation is a leading indicator, but when you strip that out, orders actually rose 0.9%, marking the 9th straight monthly increase. And that's the real story there. Strength was broad-based, especially in technology, metals, and machinery. And so we want to keep that in mind, but that's another indication that the economy is improving. I mean, we're still dealing with some of the effects of the shutdowns during the COVID era. What about international trade? Well, December's trade deficit widened sharply to a little over 70 billion. Now, this was capping off a very volatile year in global trade. Remember, we had all the tariffs in the early part of 2025. The monthly jump here was driven by higher imports and lower exports, but about a half of the increase came from non-monetary gold, which doesn't really factor into the gross domestic product. So the headline number here overstates the economic drag. And so when we zoom out from this, looking at international trade, the bigger picture is healthier. Exports are up 6.3% over the past year, and imports are down 2.6%. And so those are all positive things that are impacting trade within our global economy. So I wanted to include this here today because I think it's important when we look at migration trends. So for the past 4 years, really from 2020 to 2025, we saw a surge in migration into the U.S. So since President Trump came into office, that population growth from migration, international migration, has dropped significantly. And what's interesting is where people that are moving, where they're going. So when we look at international migration, international migrants tend to settle in states that offer more generous support for programs for lower income households. So let me say that again. International migrants coming here legally tend, and illegally, but they tend to settle in states that offer more generous support for lower income households. Okay. Meanwhile, domestic migration, that's moving between state to state within the United States, Americans continue to move towards states with lower taxes and lower costs of living. So we effectively have two different migration patterns. One that's from international migrants, and the other is from domestic migrants. Okay. And so the domestic moving is moving away from states that have lots of higher social support programs to states that have lower cost of living and lower taxes, while international migrants tend to trend towards states which have lots of social support programs, like California, New York, and et cetera, Illinois. Those are collecting a lot of international new citizens or migrants, and then domestic migration tends to be going to states like Florida, Texas, North Carolina, things of that nature. Let's talk a little bit more about tariffs. The big news the last week of February was that the Supreme Court struck down many of the tariffs imposed upon emergency powers of President Trump. And that removes one of the broadest tools the administration has been using. However, tariffs are not going away. There are lots of other legal avenues that the government is going to attempt to use, including Section 232 for national security and Section 301 for unfair trade practices. President Trump, immediately after the Supreme Court struck down his emergency powers, announced a new baseline tariff of 10% plus anything that's already been announced. So in other words, the structure may change, but the tariff policy of the Trump administration is likely to remain part of the landscape for some time to come. And this will create uncertainty in the markets. Last year, what we saw an increase, the tariffs created an increase in international securities markets, and we may see that same thing again. I don't know. It depends on what comes out. Right now, there's at least a pause in the tariff discussion because of the Iranian conflict. Okay, so let's talk about this. Iran on Saturday was attacked by the United States and Israel. The reasons for that escalation in conflict were many. I'm not going to get into that. I do feel that there's a little bit of truth on both sides of this conversation. But at the same time, we just want most certainly to make sure that our servicemen and servicewomen know that they have our support, our prayers for the families of our servicemen and women, and especially those that have already sacrificed their lives for their country. But how does this impact the markets and the economy? Well, volatility, which we already talked about, was normally higher in March. That's going to be the norm. There's a lot of things we are unsure about. There's a lot of uncertainty, and uncertainty is going to create volatility. Uncertainty was already there when we're dealing with what's going to happen with tariffs, but when we have an international military conflict, that increases uncertainty. So I say volatility is going to be the norm. It depends. The uncertainty could be there until it's not. I know this seems kind of nutty to say that. That means I'm being very unsure about when this will end. A lot of this is going to depend on about how long this conflict lasts and how deep we go. I don't know so much about military strategy and things, so I'm not going to comment here. But it seems like there's a lot more to be done if one of the policy goals is to have Iran have a new government. What was interesting about the first few days of March here, after the United States and Israel invaded, attacked Iran, was that we didn't have this tremendous flight to safety in the markets. Um, we often would have expected that. I would have thought that Monday was going to be a extremely volatile day with the market selling off, and they ended up relatively flat or not. Tuesday came around, the Dow opened down 1,200 points, but climbed its way back up to be just down slightly for the day. Wednesday was a similar day, somewhat positive. And we'll just have to wait to see how things evolve. It does not mean that we should be changing our strategy. Given that the markets have been, really kind of the response has been kind of benign. We're going to watch that. We did see yields go up a little bit in bonds because those are considered usually less risky assets when it deals with the government bonds. The things that we've seen rally in the market lately, as you might expect, defense industry companies, energy companies, especially liquefied natural gas, those things rallied. You've seen the price of oil go up quite dramatically in the last 3 or 4 days. That for Texas can be actually considered a good thing. Prices for a barrel of West Texas Intermediate is above $70, and that's usually a point at which oil producers like to see for them to actually start pumping again. Some of these things could have positive short-term impacts on the Texas economy. We'll have to see how they impact the longer-term global economy. Some of you have probably seen the maps and things of the Strait of Hormuz, which on the eastern side is the border of Iran. And you saw traffic beforehand, ship traffic beforehand and before Saturday and then after Saturday. Yes, it's ground to a very slow pace. About 20% of the world's oil production and consumption travels through the Strait of Hormuz. And that's going to impact oil prices. But despite what some of the news reports have been, the Strait of Hormuz has not been shut down by Iran. Many of the ships are waiting on either side of that strait. It's only 21 miles across. They're waiting on either side of that strait until they achieve and obtain additional risk insurance for potentially being attacked as they're going through there. I do know that for the Iranian Navy that is in the Strait of Hormuz, all of those ships have been destroyed at this time, but there's all sorts of different risks that can take place there. So companies are just trying to figure out how do they mitigate their risk before they begin traffic through the Strait of Hormuz. Many companies are trying to divert their ships around a longer route that might increase prices as well. So we're just going to have to watch that and see how that develops. So how does this all impact you? Well, one of the things that we want to make sure that we're clear about, and by the way, you can text us at 254-282-0495 for your text questions. But let's talk about our strategy. Does anything change? No. You need to talk to your advisor. We don't want to make decisions based on panicked news headlines because oftentimes that's not the real story. We read the news quite extensively. We're looking at how that impacts the markets, but this is not a time to change your strategy. We've been doing this for a week, and so we're not seeing the great dramatic impact that sometimes markets have in these situations. But you want to avoid those decisions driven by headlines. It's important to remain committed to your longer term objective. As always, we're watching these things, and if we need to make adjustments, we certainly can. But stay informed, plan ahead. Remember, your financial plan doesn't execute and stop next week. It's a multi-year process. Same thing with your retirement accounts. If you're concerned about those things, let's take a look at them. We have a number of different tools that we can use to help you navigate the market situations in your 401k. So make sure you're looking at those things. A lot of people, when there's uncertainty in the world, they want to shove the statements in the junk drawer and they don't look at them. Please take a look at those things. Make sure that you're well diversified and have a plan for how you're going to invest those assets in your retirement plans. Does this really change anything with your financial plan? No, not yet. And you want to make sure that if you don't have a professional financial advisor to talk with, give us a call. We'd be happy to talk to you. At least you'll have a second opinion that you can discuss with you and your partner, your spouse. And we always, always encourage you to take action on your financial journey. The worst thing you can do is do nothing. And I don't mean go around and scramble around and try to change all your investments right now. It's to make sure what you have is aligned with the goals you have for your future, whether that be retirement or a different career track, whatever that may be. Make sure you're talking to a professional about those things. So we'll take questions now. I'm going to look at the question board here and just see if we have anything coming in. Of course, I did not bring my glasses. Oh, there they are. I didn't have them on, so I couldn't see that I had glasses here. Okay. All right, no questions on the board, but hey, folks, we're here all the time. Make sure if you've got a question, send us a text. That's 254-282-0495. You can also contact us via our email address, info@clearvistafinancial.com. And if you'd like to schedule a consultation to visit with us, or perhaps you're a client and you want to schedule an appointment, you can use our calendly.com link there to get on our calendar. We'd love to talk to you. Until next time, folks, this has been the ClearVista Financial Monthly Market Update. We appreciate you listening and taking time to reflect on these things. Let us know if there's any questions that we can help you with. Thanks so much. Until next time, April 2nd. We'll see you then.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.